The next topic is how do we look out for bottoming out formations via other parameters. So this is where we use two things majorly. First is comparing market breadth and second is looking at RSI on the indices. So let us look at market breadth. So what we do for market breadth analysis is we take the whole universe of NSE and see what has been the correction across the universe. Because when we look at indices, what happens is Nifty is a function of the top 50 companies. Most indices are about top 100 companies, top 500 companies. But how do we get the market breadth analysis when we look at the whole market? So what we do is we compare what has been the correction in the whole universe of listed stocks on NSE in the current downfall compared to the previous downfalls. So let us take this example. This is actually a note which we wrote on 23rd, 24th March 2020. So out here we've taken the two examples, which is basically between January 18 to March 20. This was the time where we saw this big fall across the small caps, across the broader markets. It was aggravated in January 20 to March 20 in that COVID period. Now let us see what was the correction in that point, and then the other image is the correction between January 8 to October 2008. So in the first image, if you see, these are roughly around 1400 listed stocks on NSE. And what has happened to them? 79% of the stocks are down more than 50%. 70% of the stocks are down more than 60%. And almost 56% of the stocks are down more than 70%. So this was Jan 18 to March 20. Now let us look at the same parameters for the stocks in the 2008 fall. 87% of the stocks are down more than 50%. 79% of the stocks are down more than 60%, and 60% of the stocks were down more than 70%. Now look at both these comparisons. When you look at this data points, the three data points, and compare it in those two cycles, what do you see? 56% of the stocks were down more than 20%, more than 70% in 2020. 60% of the stocks were down more than 70% in 2008. Very similar when you look at all the three parameters. So what does it tell you? In 2020, it was real bad. If you compare the correction, it was almost equivalent to 2008. And the big difference being what? In the fall of 2008, preceding to that, there was a 3-year bull market. We did not have a huge bull market getting into 2018 or 2020, right? So it told you it cannot get any more worse. So this is what we wrote an article on 23rd March 2020, that it has never been so bad and so quick. And what do we see? 24th March was actually the time where we bottomed out. And we clearly mentioned if we survive COVID-19, we could see multifold returns, and what happened over the next 1 year is, we all know. Now the other parameter which we use is, which is RSI. Now when we look at RSI, it can fluctuate theoretically between 0 to 100, but it generally swings between 20 to 80 roughly. 20 to the real terminologies which the world uses is below 30 is oversold, above 70 is overbought. But what do we look out for is which is the worst possibilities across cycles. Now we look at RSI only on the Nifty or on the indices. We don't look at RSI in terms of stocks. So what we do is, how do we know how worse has the market been? So we take a daily chart with the RSI 14 for the last as many years as we can. So what do we notice is, over the last period, so the first period which we took is 1994 to 2006. What we notice is closer to RSI 20 to 25, whenever it has been touched, it has created a major bottom. So whether it was 94, 95, 96, or whether it was 98, or whether it was in 2001 or in 2004. So in those 10-year period, roughly 5 bottoms happened majorly around that 20-25 mark. Then we take the next 10 years roughly from 2006 to 2018. And what do we notice is a good bottom in 2007 out here. There was a huge rally after that. Now 2008 out here you will see there is a bottom around that 20-25 RSI. The only difference is what? This is the first fall. There was a good 20% bounce back and then we broke those lows. But there was a good 15-20% bounce. 2008 was a classical bottom. Then somewhere in 2009 also we came to 20-25 RSI. Then in 2011 we came to closer to that 20-25 RSI. Then in 2017. So whenever we've come to that RSI of 20-25, we tend to make a major bottom. Then when we look at 2019, 2020, we see that same similarity. Again, in 2018, this was a bottom. This was a bottom in 2019. Then this was the bottom in 2020. So what do we notice is, whenever we go closer to 20-25 RSI, it happens once in a few years. That has generally been a bottoming out zone. It may not bottom out right away. It could take a few weeks to bottom out, but that is the zone bottoming out is going to happen. So what are we trying to do here is, we are trying to understand when the bottoming out has happened. We don't want to be buying the bottoms, but we should realize once the bottom is done, this was a major bottom. So when the market breadth is as bad as 2008, RSI is as bad as what it has been over the last 20-25 years. When this happens and the market start recovering, on the recovery path, you can be much more sure the fact that the markets have created a major bottom. And what has happened in 60 to 80% of the times when we've bottomed at 20-25 RSIs, a lot of these bottoms have become multi-year bottoms, right? So very simple criteria. You don't need to be exactly using them just because it's gone to 25 RSI, I'll buy. You know this is a period of time where the bottoming out should happen. So rather than being fearful, you need to be calm, not necessarily greedy. Wait for your time and the things will start normally bottoming out in that period. So to sum it up, when to trade in small caps, we've looked at a few things. First is Dow theory, understanding higher tops and higher bottoms. Second is those 6 criteria, which is where we look at higher tops, higher bottoms in Nifty as well as in the small cap. No divergences between the BSE small cap and the Nifty. Relative strength in the mid cap indices, as well as a positive divergence and a breakout, and a long-term breakout happening in the Nifty as well. So when you use those parameters, you get another confirmation of when to trade. Then we went to the panic divergence part, which tells you extreme pessimism is done. Then we looked at further in terms of how bottoming out happens, which is where we looked at falling wedges and triangles. Then we looked at double bottoms. And finally, we looked at market breadth and RSI. So when you use a bunch of these parameters, what you'll see is most of the bottoming out happens with many of these parameters making a right check in your checklist. And that is when you are ready when to participate. So the 2 parts in this is, 1, we know when to participate, and then when to get ready to participate. So when to participate comes from higher tops, higher bottoms, and when to get ready is when the bottoming out is done. The next topic, which is very interesting, is when to get out of small caps. So that would be the next topic, which will be a lot more interesting because that will remove out the risk part of small caps.